Thank you everyone for joining us. I think we have over 160 participants on the call today. I'm joined, my name's Andrew King, I run distribution at Channel Capital, Revolution's non-investment services provider and partner. I'm joined by Bob Sahota, Chief Investment Officer of Revolution Asset Management, and Dr. Simon Petris, who's a Senior Portfolio Manager at Revolution Asset Management. If we just go through the first couple of slides and quickly get the disclaimer out of the way, which is a matter of course in these situations. But just quickly, the agenda for today, I'll provide a small business snapshot and update on Revolution Asset Management. Following that, Bob will cover how does Revolution withstand market downturns like the one we've just seen with regards to their philosophy. Following that, we'll look at the market opportunities that they've seen during COVID, followed by some case studies in both Australia and New Zealand. After that, we'll be doing how COVID has affected private debt as an asset class, the portfolio positioning and performance for both Fund 1 and 2, and then lastly, what lies ahead for Australian and New Zealand private debt. So we'll be hearing from both Bob and Simon, and at the end, we'll have plenty of time for Q&A. Most of you have attended these types of webinars before, but there is a portal for you to put in your questions throughout the seminar. We will endeavour to answer all of those at the end, but given the number of attendees on the call, we will endeavour to answer the ones that we don't have time for after, so we will be getting in touch with those individuals to answer the ones that we don't have time for at the end of today. So just moving forward to the next slide, I guess as a business snapshot, you'll see here on the left-hand side, the Revolution Private Debt Fund 1, which was a 7-year closed-ended vehicle, closed with 205 million, is producing a yield to maturity of 5.3%, which is ahead of the objective, 25 investments and an average credit rating of BB. Since that time, we managed to win an offshore-based co-investor for up to 300 million, and they have put a significant amount of that capital to work in investments alongside private debt fund number 1 and number 2. Aside, you'll see private debt fund 2, which is an open-ended vehicle. We have 203 million in the fund with a couple of other large investors at the back end of their commitments right now, which we'll have further news on in the next little while. The yield to maturity on fund number 2 is 6.14%, which is well in excess of the 400 to 500 over. Obviously, everyone on the call knows that Revolution do not charge performance fees on fund 2 or fund 1. There's 22 investments in the portfolio with a weighted average credit rating of BB. And for everyone on the call, we've also won a significant $300 million mandate from the Queensland Investment Corp, which is the Queensland government, alongside QIC, which they announced to the market earlier today, which is quite exciting for the team and the business. So as you can see here, in amongst those funds, we've got a growing institutional client base, a really good diverse mix of pension funds, non-for-profits, charities, family offices, ultra-high net worths and foundations. We've received great support from a number of institutional consultants, some of which have given positive official ratings for Revolution's strategy, and obviously we've got some large separate account investors that come on board. I guess ultimately I might just pass this on to Bob to first go into Revolution's strategy and the first agenda item, which is how do they Revolution withstand the market downturns. But I might just pass it over to Bob on the business growth side of things first of all.
Great, thank you, Andrew. Welcome everybody to the Revolution Asset Management private debt update and webinar. Thank you, firstly, for a lot of your support. So a lot of people on the webinar have already supported us in achieving the significant milestones that we're very thankful for your support and your continued support. As Andrew's pointed out, we've had a number of significant milestones, even since our last update, and certainly in the last year, with our private debt fund number 2 now in excess of $200 million, with a couple of new investors that will significantly increase that second open-ended fund, and the QIC mandate, which is initially 300 mil. Very good endorsement for a relationship that we've been nurturing now for the best part of 2.5 years since inception. So it is a market where private debt is becoming onto people's radar, if it already isn't on people's radar. It's becoming a more permanent fixture of asset allocation, both in institutional funds, as well as high net worth family office. So we look forward to providing you an update today on where the market's at and our thoughts and how we're positioned. So if we can just move to the next slide. This is a slide that many of you will be very familiar with. This is our attempt to show what our exact proposition is in private debt markets and our strategy. There are 3 particular sleeves that we concentrate on in our strategy at Revolution, centre around, first and foremost, senior real estate debt, but importantly, unlike many of our peers, no construction and no development, which we are extremely thankful for, that we really didn't have any of that exposure coming into the COVID environment we find ourselves in, and the recession that is inevitable across the global landscape. Private company leveraged buyout deals. These are senior secured positions in large-scale acquisitions at the top end of town of private equity. We've now done in excess of a dozen of these investments across Fund 1 and Fund 2, and ones that are household names. Thirdly, asset-backed securities. So whilst we won't go out and do individually originating mortgages, credit cards, auto loans, personal loans, or credit cards, we actually back very established asset-backed securities providers in not only the public markets, but more so the private markets, where we have a lot more influence over the terms and conditions, be able to get better return for our investors. So across these 3 different sleeves, constructing a portfolio that sets out to achieve a 400 to 500 over through the cycle return is what we've always espoused, and we'll show you through the process of this webinar how we've been able to handsomely achieve greater than that as the COVID market has affected illiquidity premium. It's important to note that with so many new private debt strategies being established or in the process of being established, this is a process and a strategy that has stood the test of market cycles. So one that I've been involved in my whole career in private debt markets, some 28 years, but this strategy has been through the test of the global financial crisis and withstood that extremely well. And now this is the second opportunity for us to demonstrate that capital preservation is the core of our strategy, and how we navigate through this period and the way that our portfolios were constructed will really determine whether we can continue to deliver the return that we've promised our investors, or ahead of that, which we are in very, very good shape to deliver. So the next slide. I
think you're on mute.
Andrew, you're on mute.
Sorry, Bob, just on the model portfolio sub-asset classes, I guess with regards to leveraged buyout debt, can you just maybe remind investors of your philosophy of the types of businesses that you try and back as opposed to those you avoid? And then maybe off the back of that, give us a little bit of a snapshot on how you think the subsectors that you don't focus on are faring through COVID, given your experience.
Sure. So in leveraged buyout deals, we really focus on the recession-proof types of industries and businesses, be that infrastructure services, healthcare, in consumer staples like Arnott's Biscuits, like mission-critical software like MYOB. Importantly, sitting at the senior secured end of those acquisitions means that you have the equity and often second lien debt that ranks subordinate to our position, that acts as a shock absorber to any losses that we might incur should there be a downturn. But we really look forward to looking at businesses that can withstand these sorts of tests, and really avoiding pro-cyclical industries such as retail, tourism, mining, construction development. So these are the kinds of areas that we like to back equity sponsors in their acquisitions. The areas that we don't focus on and the reasons why. So there's been a number of parties looking to set up in special situations, albeit lending bilaterally to SMEs, distressed or distressed debt, venture capital and venture construction debt. These are all areas that do have a valid place in people's allocation, but you really do need to make sure that you back the right manager in those particular environments. They represent much higher risk and return than what we go for, in capital preservation being the core. For instance, bilateral SME lending, you are by definition the only lender at the table. You are necessarily going to be backing smaller companies that are not as creditworthy as the kinds of businesses we look for. So should they go under and be a victim of this recession, your recovery rates are likely to be much lower. Therefore, you should be demanding a much higher return for taking on that sort of risk, as an example.
Thanks, Bob. So I guess if we just move on to the next page, how has COVID affected Revolution's strategy? Would you mind quickly going over the subsectors that you focus on and then how this recent pandemic has affected the strategy and portfolio, and then ultimately what market opportunities this has led to with regards to those subsectors in terms of risk and return?
Sure, Andrew. So private company leveraged buyout debt. What's happened in that market since COVID has arrived on the scene? I would say the balance of power has shifted dramatically in the favour of lenders. What do I mean by that? There is, prior to COVID, there was almost a wash of money in terms of the market and lots of liquidity, as I'm sure everybody's read about. So private equity had the driving seat in making what they wanted in deals a reality, be it more flexible terms, higher leverage, and lower and lower economics in terms of upfront fees and margins. So with COVID arriving, we now see the ability for us to negotiate to really be in non-COVID affected industries, firstly, then to have lower leverage, and then the economics coming off the back of that in terms of the upfront fees and the margins that we're generating now for new deals are significantly better than pre-COVID. There is remaining a significant amount of dry powder in the leveraged buyout market. So the Australian Investment Council has mentioned that there's a circa $13 billion of dry powder in private equity that's awaiting deployment in private equity land. And as a rough rule of thumb, $1 of private equity has to be met generally with $1 of debt in an acquisition. So there is a significant forward pipeline, the way we see the continuation of 2019 being a very active mergers and acquisitions year in terms of new deal flow. And what we see going forward is a lot better terms for us going forward. So less covenant light deals, more full covenanted deals with better pricing and lower leverage. So all of that augurs well, and it's a bit similar to what we saw in the aftermath of the global financial crisis, where again, all of these things were coming to the fore at that point. I might invite my colleague Simon Petris to talk about the update on ABS and asset-backed securities market.
Thanks, Bob. The key issue in the ABS market is really around payment deferrals related to COVID. And the million-dollar question is really around what happens when these deferrals end and what percentage of these loans actually end up defaulting and what percentage go back to being good performing borrowers. The chart on the right from Fitch gives you a bit of a snapshot of what's going on in the mortgage market, and you can see on the left-hand side, the major banks have around 10% of their mortgage book in payment deferral. They've been relatively accommodating in allowing people to defer and capitalise interest on their loans. You can see the non-conforming mortgage pools are relatively high at 20%, and really COVID has really hit the SME sort of self-employed borrowers hard, which is why the deferrals are around those sort of levels. You can see New Zealand's an interesting case, also around the 10% mark, but a much larger proportion of borrowers are paying IO or partial payments as opposed to the sort of full payment deferrals that are happening in Australia. In Fund 1 and 2, we have around 40% of our exposure to ABS, and the majority of this is in private ABS warehouses. And the warehouses and investments that we're involved in have relatively much better deferral levels around between sort of 1 to 4%. And that's really testament to the amount of time we spend reviewing the originator's whole credit underwriting process, and we get down into the weeds and we really look at individual loan files and how they originate loans and whether or not we would have written these loan files. We also spend a hell of a lot of time modelling these transactions and ensuring that they have sufficient structural protections and buffers to protect against significant downside scenarios, and we're comfortable that even if a majority of the loans are in deferral default, that we've got buffers and protections in place to protect our investments. The surprising thing we've noticed since COVID is really that you would have expected auto and consumer loans to probably have higher payment deferrals than mortgages, but it's actually been the opposite case. It seems that a lot of borrowers have been sort of hitting the deferral button on their mortgage, which is the larger payment at a lower interest rate, and really using this opportunity to pay down sort of more expensive debt on the auto and consumer side. So interesting behaviour.
And then on the senior commercial real estate sleeve, we've been very, very selective, and really a lot of what we looked at didn't pass muster for our overall strategy in terms of capital preservation. But what we find in a post-COVID environment is the landscape has changed for a long time, if not forever. Will we see the same level of demand for office space as a lot more people are going to be working remotely and flexibly? Discretionary retail, with a lot more online shopping these days versus foot traffic in centres. So I think we were quite cautious on the sector. We continue to focus on quality underlying tenant cash flows, not just pure valuation. This is where we have a distinct advantage, I believe, and a differentiating factor to many of our private debt peers in the market. We don't just lend on a point-in-time valuation. We lend against real cash flow and look for the cash flow to pay our debt back rather than simply being able to sell the property and get our money back. This is a much better and more safer way of lending into the real estate markets, and things are moving in our favour in this market as well, with capitalisation rates and valuations, or cap rates increasing and valuations as a result falling. There's an ability for us to reset.
Thanks. I think if we just pop forward on that, Bob, obviously you've only got one investment in the real estate sector across both funds, is that right? And that's in Fund 1.
That's right, yeah. So we've been, like I said, very selective. Not many deals have passed muster from either a relative value point of view or, in fact, the risk point of view of what we require for us to be comfortable with those sorts of deals.
Thanks. And then I guess the next slide is really on the COVID premium that we've discussed with a number of investors and what the COVID pandemic has offered up in terms of risk return for each of the subsectors. Yeah, so this slide is really just on one page explaining what has happened to the market in terms of yield pre and post COVID. So you can see in each of the sleeves, LBO, real estate and ABS, triple Bs, where the all-in yield was before COVID arrived. And what you can see now is a consistent shift of at least 1 to 1.5%, and many times more in terms of the overall yield that we've been able to attract, importantly, for the same level of risk. So for the same given level of risk, we're able, because this illiquidity premium has increased, we're actually able to harvest better risk-adjusted return in this environment than pre-COVID. And that is really manifest when we get to the performance of Fund Number 1 versus Fund Number 2. You can see that very clearly in the two vintages of 2019 and then in the ensuing 2020 period. You're on mute, Andrew. Sorry, guys. So I guess from the next two slides, credit's a pretty dry topic for a lot of investors. So we thought we'd bring this to life with some recent case studies and deals being done actually during the COVID crisis and what these opportunities actually look like and how that speaks to your philosophy. So I guess the first one is in leveraged buyout loans. If we can touch on that, it'd be great.
Sure. So this is a company that we backed in terms of providing the senior secured lending to. This particular company has been around since 1995, has operations in 10 countries with 800 locations. What it does is basically take unemployed people, be they able-bodied and also disabled people, to find long-term employment solutions. And they also administer government insurance and corporate health programs. Importantly, they've got incumbent positions in government contracts that they've actually been able to administer for long periods of time with the highest level of industry ratings and accreditation. So if you think about it in a COVID environment, this is a company that is actually quite counter-cyclical, with operating in 10 different countries where unemployment rates are set to dramatically increase as a result of people sadly losing employment. This particular company is well placed to assist the governments around the countries that they operate in getting these people back into the workforce in long-term employment, so that they are not a burden on the economies that we're talking about, and actually are actually productive members of society, paying taxes rather than being on welfare. So this particular deal was a $500 million senior secured syndication. As I mentioned, the senior secured position, the leverage of the company at the senior position is 3.5 times debt to EBITDA. For a total acquisition multiple, so this is what the private equity firm paid in terms of multiples of EBITDA, was 11.3. So what that means is there's almost 8 turns of EBITDA that sit below us in the form of second lien and equity in the capital structure as a shock absorber. So we're right at the very top of the capital structure in that. And now the yield that you can see in this particular deal, I would say is one of the best yields I've ever done in my career of 28 years in leveraged buyout lending. So for the senior secured position, we're getting a yield of 8.2%, which included a upfront fee that we received of 5%, which again, I've never seen a upfront fee being paid of 5%, even when we're putting much larger pieces to work in syndications. A term of 6 years.
On the upfront fees, that goes to the fund to the benefit of investors, correct?
Yeah, so our philosophy on all fees that we receive is very clear. We pass all fees that we derive from any transaction in their entirety to the fund. So that is all passed on as part of the yield for investors investing in the fund. And I would say the last point that I'd like to make on this one is, because of relationships and being very close to the sponsors and the underwriter, we were able to be one of few parties in that whole process that were able to get our full allocation for ourselves in terms of Revolution Private Debt Fund number 2 and our new separately managed account for a combined total of $44.5 million.
Great, thanks. So I guess New Zealand, in Revolution's case, is a slice of private debt heaven, pardon the pun. And it really is a key market for you guys, being about roughly 25% of your investments to date across both funds. I guess, Simon, why is it that you guys like New Zealand? And then I guess on the second thing that comes up a lot on ABS, you guys are obviously specialists in ABS, and many investors on the call are probably quite familiar with the public market ABS. I guess, can you just highlight what you guys focus on, given the fact that you actually focus on private market ABS, and you being one of the largest participants yourself over the last 6 or 7 years in that? What is it, that skill set and that differentiating factor that you bring to investors that could get access to this private ABS market transactions that you involve yourself in?
Sure, thanks Andrew. Yeah, as you said, most people are familiar with the public RMBS and ABS markets, and these are reported on. There are strategists that cover these, and the bonds are visible on Bloomberg. But essentially, each public ABS and RMBS issued has to be built up on the private side inside a private ABS warehouse, and this market is essentially much bigger than the public market, but it's not anywhere near as visible or accessible and easier for investors to access this type of exposure. As you said, warehouses represent around 3/4 of our overall ABS exposure in Fund 1 and 2, And we really see, the access that we provide to investors, to high quality warehouses as a key differentiator for Revolution as a private debt manager, because very few other private debt managers have the skills, experience or mandate to access this relatively inefficient market, which we believe provides excellent return for the risk. I've spent my whole career structuring and analysing ABS investments, and I've got a background with a Ph.D. in maths, and we spend many weeks, modelling the transactions and making sure that they can survive significant, downside scenarios like the one we've experienced during COVID. We also spend a lot of time negotiating the eligibility criteria and portfolio parameters with the originator and go through their whole credit underwriting process and pull individual loan files and make sure they're the type of loans that we would be comfortable writing ourselves. So to the second part of your question, why New Zealand? Well, there are a number of reasons, but first and foremost, there's less competition from insto investors. We feel in general the underlying loans are of a better quality, slightly better quality versus Australia, and there's usually better credit protection available for warehouse investors, and you also get paid more due to that lack of competition for assets. So why are the underlying loans performing better? Well, there are a number of reasons, but one I'd like to touch on in the New Zealand mortgage market is really to do with LVR. So in general, Kiwi mortgage borrowers are less levered than their Aussie counterparts, and that's really due to the RBNZ enforcing speed limits around the banks with regard to owner-occupying loans being 80% or below, and then investor loans being 70% or below, which we've got a chart from the RBNZ in the middle of the page. So how do you access New Zealand private ABS warehouses? Well, historically the banks have dominated the market. They've been up to 89%, and the public ABS market is relatively small. So really, access to the private warehouses is key. And with the RBNZ capital changes in the pipeline, with Tier 1 capital going from 8.5% to 16%, we really feel like this opportunity is going to open up for non-banks to take market share, as has happened in Australia. And with that in mind, in May 2019, we partnered with a major non-bank originator active in Australia and New Zealand to really target this opportunity in prime and near prime mortgages. This warehouse recently had its 1-year anniversary, and we repriced it and received a COVID premium essentially for the repricing. And I've got the high level transaction information on the right of the chart. So total facility size of 175 mil, which we expect to grow significantly over the coming years. The majority of this funding comes from the banks which provide the senior AAA funding. We provide the crucial mezzanine tranches, which at this point are 16 mil, which are across Fund 1 and Fund 2. The blended credit rating of this investment is internal credit rating is a single A via an S&P methodology, and the weighted average LVR on the whole pool of mortgages is only 72%. So on average, 28% borrower equity as a first line of defence against losses. The maximum LVR in the pool, 86%, which means it's not a barbell portfolio, with a lot of high LTV loans offset by lower LTV loans. The term 12 months and the current yield blended at 6%. Importantly, this is a floating rate investment, and we've been able to negotiate floors at 0. So if the RBNZ did go to negative rates, that wouldn't be an issue for us in this transaction. The current level of COVID arrears is also 1.6 for full payment deferrals and only 1.5% partial deferrals. And as I said, we've done extensive modelling to ensure that we've got sufficient credit protection to make sure our investments are protected, even if a large portion of these borrowers were to end up defaulting.
Just a quick one on that, Simon. When you say prime and near prime, is that the more conservative of the mortgages? Is that correct?
Yeah, that's right. Yeah, so with non-conforming, having a large number of self-employed borrowers being at the sort of the edgier end of the mortgage market.
Yeah, great. So if we just flick forward from here, Bob's going to give us a bit of an update on the portfolio positioning and performance of Fund 1 and Fund 2, and then we'll move on from there.
Great, thanks Andrew. So this is portfolio number 1, so Revolution Private Debt Fund number 1. which, as we mentioned, is a closed-ended 7-year vehicle that we invested over the course of 2019. You can see there, commercial property is a smaller allocation. It's dominated by leveraged buyout and ABS. We really want everybody, and particularly on this webinar, we know there's a number of people in New Zealand who are interested and a couple that are already investing. New Zealand is a key part of our strategy that we see as being quite a high risk adjusted return and a key differentiating factor of our strategy versus many of our peers. So across both of our funds, there's a very good representation in New Zealand, 22% in this fund and even higher in fund number 2. We set out to achieve a BB average credit rating. That's exactly what we're delivering if you look at the pie chart on the right. Turning to the next slide, we look at performance. So performance for this particular fund, again, as I mentioned, it was invested through the course of a pre-COVID environment in 2019. Bearing in mind our original target of 400 to 500 over the RBA cash rate was our original target. This, in all periods, and particularly since inception, is very much handily beating that original target. You can see the yield to maturity of 5.3 and the committed investments. We set out to have 20 to 25 investments in this fund. That's 25 now in the fund, with it being largely fully invested now, almost completely done. Very low interest rate duration, so we don't take a view on rates in any of our strategy, and only a 2.4 year credit duration. We have a very strong very strong declining rate. So the approval rate on this fund was only 18%, which meant that we're still turning away more than 80% of the deals that we're seeing. And that is really testament to being across the 3 different sleeves of private debt in Australia in order for us to minimise the risk, but to deliver what we've promised to achieve. Turning to the next slide, we move on to the Revolution Private Debt Fund number 2. No real estate in this particular fund as yet. We are hopeful that opportunity opens up throughout the course of this year and next. This particular fund is open-ended, which with a wholesale vehicle that many of your clients on this webinar are actually invested in the wholesale vehicle that feeds into the master fund. These are statistics for the master fund. You can see there 25% in New Zealand, as I mentioned, key part of the strategy. And again, BB sort of credit rating is the average for this particular fund. Again, exactly what we set out to achieve through the course of our strategy. Next slide. The time series on this is a bit lower, given that the first close of this fund was on the 27th of December last year. But you can already see the vintage of 2020 really highlighting the COVID premium that we're actively harvesting in the market today. So if you compare the vintages of fund number 1 to fund number 2, there's a circa 85 basis point increase in fund number 2 in yield to maturity terms. And that really is a function of the same risk. So you can notice the average rating is still BB for this particular fund, similar to fund number 1. Credit duration, interest rate risk are very similar. We've already up to 22 investments in this fund and growing. The fund has been deployed a lot faster than we thought as well, as a result of a good runway of activity and opportunities that we found with a lot of our peers not being as active as they were last year even. So we've been able to, in a very short period of time, circa 8 months, deploy $176 million. And with our forward pipeline, that's getting close to $200 million in that fund already being deployed. And there is already a couple of larger investors that are coming into the fund to grow our overall dry powder to this fund with continued support. We see some excellent opportunities going forward in private debt markets. So really, what lies ahead for the Australian New Zealand private debt markets? This is really a summary of what are our thoughts. So nobody's got a crystal ball from here up. Markets are really trying to work out whether there's going to be a vaccine, how long the pandemic is going to be around for, what are its implications for global trade and global borders. In fact, even domestic borders are being debated on a daily basis. So what does that all mean for a private debt strategy? Understanding that when we make an investment, it is an illiquid investment. We don't have the opportunity to trade out of it. It really requires continued discipline to make sure the investments that we make will be able to be tested through a bumpy ride. And that's exactly how we constructed the existing portfolios, but it's even more important to maintain that visual credit discipline going forward. There will be, sadly, a lot of industries and businesses that will not be able to survive this current crisis. That is really going to be leading to much higher levels of unemployment, higher rates of default, and corporate bankruptcy. And they're going to be in industries that have borne, the full brunt of this pandemic, be it advertising, tourism, retail, mining, construction, development. All of these areas are ones that we were actively avoided. The next point, patient capital. Very important to match the capital to the opportunity. So a lot of the peers that have raised private debt money or look to invest in private debt have offered on the other side liquidity, even though the underlying assets are illiquid. It's important to have a fund structure that matches the underlying investments and their maturities. So at Revolution, we have a very strong philosophy to make sure that we only really target patient capital that can take advantage of this underlying illiquidity premium, but you do give up access to your money on a daily basis. And that's exactly how we deliver the types of returns that we've been able to achieve. And really lastly, the thing that resonates with a lot of people that we're talking to these days, and some of the decisions for larger institutional investors in particular to allocate to a strategy such as Revolution's, is through this period, traditional fixed income isn't really providing income. Our strategy in private debt, in the hands of a disciplined manager, still provides you with very high levels of income that is uncorrelated to any of the other asset classes that you might be invested in. And really that is the source of what we believe is our continued success and what we believe is very attractive proposition from everyone from high net worth to family office to foundations, all the way through to large superannuation funds.
Thanks, Bob, and thank you, Simon. I think we will now move on to the Q&A section. So apologies everyone on the call, there's quite a few questions to get through here, so hopefully we'll get through most of them. One question that's come through is what do you think the fund capacity of the Revolution strategy is in this market?
Excellent question. One that we get often asked in our meetings we're having. We believe, given the dearth of the number of actual private debt managers in the sleeves that we operate in particular, being very infant, as well as we're really at the beginning of the journey in terms of the opportunity. The banks have acted as asset managers in their own right for a long period of time, but we're starting to see that market really opening up for private debt. But it's a very difficult thing, and we've seen it firsthand, in order to get to critical mass. So we're getting to circa $1 billion plus in commitments, but that early stage of our journey was not that easy, so there are significant barriers to entry. So there's, as a result, only half a dozen managers. So to answer your question, what is the capacity? We see our strategy being multi-billions of dollars and still having sufficient runway for us to continue to grow as this pipeline of opportunities really is quite significant going forward. We've done the numbers on the three sleeves. We believe on an annual basis there's $24 to $28 billion of an addressable market across our three sleeves, and against that there's only half a dozen managers in Australia that are of any critical size. So what does that all mean? A very, very bright future in terms of opportunity set and capacity.
Thanks, Bob. Another question that's come through. Some private loan participants seem to resist transparency in terms of giving away primary and life cycle pricing on the loans that they've been involved with. Do you think more clarity will benefit or weaken the sector and ability to generate optimal performance?
Life cycle pricing on loans? I'm not quite following.
So I guess the question is around transparency the manager is giving, like you've just done, in terms of the pricing on the loans that you participated in? Do you think there needs to be more clarity from managers on this?
So look, we have to respect confidentiality, and this is private market. So we always are treading a fine line between what we can and can't disclose, what is in the public domain and what is private. We generally are quite happy on a no-names basis to provide people with quite a lot of granular detail on the types of investments that we're making, what loan pricing that we're currently achieving in the market for a particular industry and a particular leverage type. That is quite a lot of due diligence that's been done on us, be that by asset consultants and by larger institutional clients. So we'd be all for more transparency in the market. And given there's a big spectrum of risk return in the loan market in particular, all the way from corporate loans at 200 over, all the way through to holding company debt that might be in the mid-teens. So there's a big continuum of risk return in the market, but we're very happy to show where we see the risk return for what we do in our strategy.
Great, thanks. Another question is a pretty direct one, which I think is great. Has there been any portfolio impairments as a result of COVID across the three investments that you invest in within your strategies?
So very direct question deserves a very direct answer. So we can honestly say hand on heart that we have absolutely no impaired assets. That is not only just myself and my colleagues being able to tell you that. We have an independent party called Leadenhall who do evaluations on Fund 2 on a monthly basis. So in doing those valuations, they look through all of the private information that we receive as a lender on a real-time basis on every one of those positions to ensure one thing, that these assets are performing as per the original base case when we went into these deals. We, as at the end of July, had a full clean bill of health and a sign-off saying all assets are performing, so we don't have any issues right now. And I think that really comes to the fore with the discipline that I talked about is what is part of our core philosophy. We will find out in short order over the next 3 to 6 months how some of our peers are actually performing through this period, because inevitably those bankruptcies and issues are going to happen on the more cyclical industries. But we, as I mentioned, are very proactively avoiding those sorts of deals and thankfully don't have to worry about that. We can continue to build our business.
Another question here is, how do you manage the liquidity in the institutional fund and then the wholesale fund?
So liquidity is one where it's a very measured way that we can look after redemption. So in the master fund, we have for larger institutional investors of greater than $1 million commitment plus, there is a 1-year hard lockup. And post that 1-year lockup, we can actually match off any new applications in the fund with any redemptions. So that's an automatic way that we can actually provide liquidity. In the worst case where redemptions outweigh applications, there's an ability for us to actually move the amount of redemptions into a pro rata piece of all of those transactions at that point into a side pocket, such that every one of our deals has a legal final maturity date. So through the fullness of time, if those applications don't pick up, as deals repay, instead of reinvesting into the master fund, we simply return the capital to the redeeming investor. So in that way, there's a very staged way that we look after people looking to exit the fund, but also look after the people that want to remain investing in the fund so that we're administering our fiduciary obligations in a very crisp way. On the wholesale side, for the smaller investors, we're again able on a quarterly basis, or we can actually accept capital on a monthly basis, but on a quarterly basis look at redemptions and match again the applications and redemptions. But again, on a worst case scenario, because it invests into the master fund, that we tell people on the worst case scenario that you should be thinking about, getting your last dollar out on a average of the credit duration, which is about 2.4 years.
Thanks. And then another one is, could you provide some examples on AA versus BB transactions in terms of what you see as relative value in the portfolio that you've got?
So Simon might have to answer that one, but the high investment grade deals that we do are generally in these mezzanine tranches of private asset-backed securities warehouses. So this is where we're providing the capital that sits below the bank AAA and AA generally. And so what we do is map those particular tranches to a stated S&P methodology. So again, we're looking at a very formulaic way that we're actually assigning those ratings, and then looking at the relative value of what they actually achieve for us. So to give you an idea, in every one of the ABS examples, there is a significant premium because it's private, and it's because it's bilaterally or trilaterally negotiated with the bank and the mortgage or the ABS originator, that we're actually getting quite a decent increase from where the observable markets are. Say for a single A or double A rated investment in ABS land, we're generally getting in the order of 200 to 300 basis points more than that because of that private nature and illiquidity premium.
Yeah, I'll probably just add that, we feel like we are getting really overpaid for the risk in the sort of the AA tranches in the ABS warehouses, but really the opportunities come about due to regulation. So previously, before January 2018, the capital rules from AFRA really allowed the banks to go down to probably the BBB level, and so offered in warehouses you only needed a bank and the originator, but because the regulations changed and really limited the banks at the AAA level, it's left a big gap in the capital structure where banks can't provide that funding and the originator doesn't want to put in, an enormous amount of first loss and tie-up capital in that part of the capital structure. So it's really opened up the opportunity for non-bank investors like ourselves to provide that capital, and we have to earn, a significant margin on that, but it's better than the originator having to put in all the equity themselves. So it really is strong risk return at that level.
Thanks, guys. Another question that's quite relevant is, what is the average size of deals that you look at across these subsectors, I guess, and with context of what does that give you now that your scale has gotten bigger?
So generally, in leverage buyouts, it's a slightly different question answer on leverage buyouts to ABS, but in leverage buyout deals, we're still relatively small player in very large transactions. So that example we provided you, that $500 million syndication, we're only $44.5 million. So in time, we can grow in those syndicates. In ABS, we are generally the lion's share of those mezzanine notes alongside the bank who provides the AAA and often the AA. So we're more a proportion of those. But in the end, we're negotiating in good faith with all parties on that ABS transaction with very, very strong terms and conditions that are attached to ABS transactions for us to be able to be comfortable that we don't have a position where, should the market turn down like a recession we're having, that we actually get impacted and lose any of our principal.
Yeah, I'd say in the ABS, it probably ranges from 100 and 150 mil total facility size, the minimum, and then there are warehouses where we can speak for sort of up to about 60 million across different vehicles and different investors in pools that are sort of 800 mil in facility size.
I should mention that when we started our journey, we were only really relevant to smaller warehouses. Our capital was only $10 to $15 million. As we've been able to grow our funds and asset under management, as well as the separate account, we start becoming relevant to a lot more ABS providers, and particularly the larger providers. So we can really grow in scale with the scale of the sponsors that we face.
Thanks, guys. And then another question that's come through is, can you please give us a bit of an idea of your philosophy around being in syndicated loans versus bilateral loans and what that means for investors, knowing that, I guess, you mentioned it earlier on, but how do you look at that versus risk? And then second question on that is, a couple of investors have noted here on the Q&A, we notice you don't charge performance fees. We're used to there being performance fees in private credit. Can you touch on why you don't as well?
Sure. So to really unpack the bilateral lending opportunity, and look, I'm the first to say there's an opportunity for private debt investors to go into bilateral lending. I would say though, you need to go into it with your eyes wide open. So to do that, you need to be a mini bank. So you need to have the end-to-end resources to be able to provide, the whole, provision of the whole debt package. So that means you need to be able to, look over all the legals, the tax and structuring implications, being able to do all of that bilaterally facing the sponsor alone. We certainly are not, and for that, you necessarily want a higher return than what we generate. Now, what you give up there, so being a smaller investor, you are then, as a bilateral investor, necessarily going to have to lend to smaller companies. And small is the first thing that credit rating agencies look at, which is scale. So scale will firstly determine mostly about where your credit rating will end up. So being very small means that you generally don't have as stronger barriers to entry. You don't have, you have a lot more competition. You've probably got a few large dominating players in the market you're competing against. So being a bilateral lender means that you're taking a significantly higher risk than what we do. So you should be really compensated for that, because if you default or that company defaults, you will end up getting a very, very low recovery, if at all. On the other hand, why do we focus on syndicates? So syndications mean necessarily we can then back number one and number two player companies with very high barriers to entry that have got a long track record of cash flow generation that we can reliably bank through the cycle. So in that way, we also benefit in the same terms and conditions. We share in the same security as all other lenders. So should we end up in a position where it's an underperforming asset, it needs to be restructured, we end up on the same side of the table in negotiations as the 800-pound gorillas, being the other banks and syndicate members, where we collectively can exert, a great deal of pressure on the management and the sponsor to make sure that we stand the best chance of getting our money back. So for us, that's a lot better place to be, being a smaller investor and growing, than trying to be a shadow or mini bank.
And I guess, Bob, does that then lead itself to where ultimately the best thing you can do for investors in assessing loans and private opportunities that you see is vote with your feet?
Yeah, so we are very, very selective, and the reason why we're across these three different markets and sectors is we want to have the ability to say quick no's. So if it doesn't fit our criteria for any one reason, be it it's the wrong sector, the wrong leverage, the wrong terms and conditions, the wrong economics, the wrong sponsor, the wrong management team, any of those issues, we can easily say no and there's no harm done. And really it harks to the best we can ever do is get our interest payments as and when they're due and get our money back at maturity. And if you keep that in mind, that really answers the second part of your earlier question about performance fees, where we don't want to have an incentive where we're taking on more risk than what we promise our investors. Therefore, in a capital stable product of what Revolution Asset Management seeks to achieve, it makes no sense to have us have an incentive to take on more risk than what we've advertised. So we have a philosophical view on charging a flat management fee with no performance fees, with all of the fees that we receive on any particular transaction being for the benefit of our investors. And that's what I believe is a strong platform for growth into the future for our business.
Okay, I think coming up to 22 minutes past 1, and it's about 50 minutes. I think we might just flick to the last contact page, Matt, if you can do that. And look, I'd just like to thank everyone. We had over 160 attendees on the call today. Thank you all for attending. On the few questions that remain, there are 10 or 15 questions. We'll get back to you in due course. Thank you everyone for joining, and please feel free to reach out to any of us on this last contact page, and we'll be pleased to get back to you with any queries you might have on the strategy or the team. Thanks very much everyone for coming.
Great, thank you.
Thank you.